Okay, let's go ahead and go through the solution to the first of the three standalone examples from intercompany sales of long-lived assets. This is an upstream sale of land, and we'll be using the partial equity method. Okay, so again, we assume that big company owns 90% of little, and that on January 1st, 2001, little sells land costing $100,000 to big for $110,000. A couple years later, on August 1st, 2003, Big sells this land to a third party for $115,000. Assume that Little reports earnings of $100,000 each year and pays no dividends, and that Big uses the partial equity method. Required, we need to provide the equity method entries related to Big's investment in Little for 2001, 2002, and 2003, and also provide the elimination entries related to this transaction for 2001, 2002, and 2003. And again, one of the advantages of using this sort of modular approach to the elimination entries is that we already know how to do the S and the A and the I and the D entries, so we're just going to go ahead and focus on the new aspect, these additional elimination entries from the intercompany transaction. Third, we need to indicate what would be the income to the non-controlling interest be in each year. Again, this was an upstream transaction. Little sold the land to Big, which means that the unrealized gain from this transaction will affect the non-controlling interest. Now, the land was sold from Little to Big at a $10,000 gain. Under the partial equity method, Big will not adjust their investment income to negate or eliminate the unrealized gain, nor to subsequently recognize that gain when it is finally realized. Okay, starting with 2001. First, our equity method entry. There will be no equity method entry related to this transaction. Again, we're using the partial equity method, which means that we will not worry about eliminating or undoing or negating or offsetting any unrealized gains or losses from intercompany transactions. Basically, under the equity method, Big is going to report their proportionate share of Little's reported earnings. Little's reported earnings are overstated, and that means that Big's investment income is going to be overstated because it includes their share of that unrealized gain. That will flow through and subsequently overstate Big's retained earnings. So as we do the elimination entries in subsequent years, we're going to constantly be having to adjust or lower Big's retained earnings to get it down to its proper level. Our elimination entries in the year of sale, again, Little has that $10,000 gain on sale of land on their income statement. We have to eliminate that gain by debiting gain on sale of land, and at the same time we have to reduce the land back to its true historical cost. Again, its true historical cost was $100,000. It's on Big's books now at the inflated $110,000, so we need to strip away $10,000 to get it down to its correct level. Third and finally, the income to the non-controlling interest. Again, the non-controlling shareholders are going to get their share, 10%, of the subsidiary's adjusted/realized earnings. So as before, we start with the reported earnings of $100,000, but then we go ahead and take away $10,000 of that because that portion is unrealized. The realized earnings are only $90,000, and again, the non-controlling shareholders will get 10% of that, or $9,000. In 2002, we go through the same process. First, for the equity method entries, there's nothing going on. For the elimination entries, again, first we have to reduce the land back down to its true cost again, and we'll have to do this every year for as long as Big Company owns the land. The land is on Big Company's balance sheet at $110,000. We've got to lower it down to $100,000. On the debit side, we're carrying forward that unrealized gain. And again, there are two questions that have to be addressed here. First, is it an upstream or a downstream transaction? Since this was an upstream transaction, it affects the non-controlling interest. So that $10,000 unrealized gain is going to be split 90-10 between the parent and the non-controlling shareholders. The second question regarding the debit of $9,000 is, does Big use the full or the partial equity method? And again, as I indicated a moment ago, Big is using the partial equity method, which means that they're not adjusting their investment income to remove that unrealized gain, which means that BIG's retained earnings is $9,000 too high. So we're going to go ahead and fix this by reducing BIG's retained earnings by $9,000. And as always, the worksheet adjustments to retained earnings are made to the beginning retained earnings balance up in the statement of retained earnings on the worksheet. Third, the income to the non-controlling shareholders. There are no unrealized gains or losses this year. The unrealized gain was last year. So this year, all of Little's earnings of $100,000, those are all realized, so the non-controlling shareholders get their 10% of that, or $10,000. Now we're down to 2003, the final year. And again, this is the year when the land gets sold by BIG to some external third party. And again, under the equity method entry, we're going to have none because, again, under the partial equity method, big company is not adjusting their investment income to record unrealized gains or losses or their subsequent realization. For the elimination entry, we again carry forward that unrealized gain for the final time. Again, in 2003, BIG's beginning of year retained earnings is still overstated, so again we have to lower their retained earnings by $9,000. And on the credit side, that $10,000 gain from the sale 2 years ago is finally being realized. So now we're going to go ahead and recognize it on the consolidated income statement. And then finally, the income to the non-controlling shareholders. Again, they get their 10% of the subsidiary's adjusted/realized earnings. So in addition to Little's reported earnings of $100,000 this year, we're also letting them realize or recognize their share of the $10,000 formerly unrealized gain. So the non-controlling shareholders get 10% of $110,000 or $11,000.